Welcome to TheoTrade. This is Don Kaufman. It is August 8th, 2018. You are watching the Theo Night video. The S&P has just closed moments ago, down about $3.50. I mean, people, this is about as close as we call it to massively unchanged on a given trading day. With that, as you look down the list of some of the usual suspects, the Nasdaq is relatively unchanged. The Russell backs off a little bit. But really, what I've been watching throughout the course of the day happens to do a tremendous amount with volatility. I mean, for the most part, the VIX even dropped back into the 10 handle. It's been quite some time since we've seen the VIX, again, back down in the 10 handle. And again, volatility, dead. Long live volatility. That is really the question for tonight's video, is with the VIX back down in the 10 handle and all of us kind of, circling the wagon a little bit here, thinking about like all the risks that are looming in this marketplace. Is it effectively time to buy volatility? Well, I may have a few answers specifically to that question. We're going to build a few trades and we're going to get long volatility. But one of the most important things about these trades is I don't want them to cost me much up front, and I want to be able to give myself duration. And what that basically means is, listen, I don't know if volatility is going to go up tomorrow. I do know, though, that over the last 10 years, ironically, August has been the most volatile month in the last 10 years. Historically speaking, September also, volatility really picks up. October has had a couple of crashes in it. But this is the kind of question that looms here. Should I be buying volatility when the VIX is back down in the 10 handle? And I think it's relatively easy to be able to answer that if you've got the right strategies to be able to employ that aren't going to cost you that much up front. Let's go over to the VIX to begin with, and, well, let's get started. You can see I've got a number of strategies already kind of, baked into the volatility index here, but I'm going to go all the way out to October, and I'm going to build what I term a VIX volatility spread. So let's go ahead and let's start to build our VIX volatility spread and kind of follow along. This is going to be one of two separate positions that I'm going to look at to get what I term net long volatility. But remember, I want duration. So duration, initially I'm going to go out to October. And in this particular circumstance, again, these are trades that can be placed. You don't have to panic to put these things on. Just work them, especially in like low volatility that we're in. So I'm going to go out and I'm going to go and sell a 13 put. Now, why am I selling the 13 put? Well, I want to sell 13 put to be able to collect 70 cents, but I'm doing that in effort to purchase a call spread. Again, I want to be net long volatility. All right, so now I've sold the 13 put, and then I've turned around and purchased with that credit the 16.20 call spread. So it's a $4 wide call spread that I was able to afford with the sale of the 13 put. But if you sell a 13 put and you effectively sell it quote unquote naked, all right, it's going to tie up a little bit of margin. And again, I happen to be in an IRA in this particular account. And if you look at this, like, oh no, the max loss, the buying power effect in here is almost $1,300, right? If you sell a 13 put, it's going to tie up $1,300 for one contract. So how can I fix that? Well, I can also go out and buy the 10 put on top of it. So what I'm doing is selling a 13 put and buying the 10 put to offset some of that margin. Okay, and listen, the 10 put's only going to cost me 5 cents. Actually, right now, if you take a look, it's still showing a 10-cent credit for the entire trade. And we'll take that and we'll throw it over to the Analyze tab. And what we're looking at right now is the risk graph in the Analyze tab. So, well, what's the risk in this trade? The risk is if the VIX stays where it's at or even goes a little bit lower, well, effectively we'd have some risk. But listen, if at any time that volatility really kind of spikes, okay, so volatility spikes between now and like October expiration, hey, we're great. And you can kind of see the risk graph. If you're not comfortable looking at the risk graph that way, we can actually use what's called expiration plus one. This is a little bit more of like the expiration risk graph that people are a little bit more familiar with. For the most part, we don't really make anything till we hit like 16 in the VIX, and then we just explode to the upside and can't make much more over 20. So it's a way to effectively get long volatility, and we're financing it by selling a put spread. Now, could we lose money in the put spread? Sure, you could lose money in the put spread, right? What? It's a 13.10 put spread. So there's $3 of risk in here, but the only way you can lose the full $3 is if the VIX was under the 10 region by October. And again, I believe that sometime, okay, in the next what? Take a look. The next 69 days, you're probably going to get some bump up in volatility. And even if you don't, you kind of recognize you could take this put spread and you could roll it out in time. So that's one idea. And again, reprice this thing. Let the lock open here. See, it's really at 10 cents. Reprice it as time kind of goes on tomorrow. And if, we do get a bump up in volatility in just the next couple of weeks, hey, we're good to go. So what's another idea? Because the VIX can be a little bit convoluted for some people. Personally, I happen to like it, not because it's a convoluted product, but the product happens to make a whole lot of sense. It also happens to be the VIX itself is, this European style option. It's nice. You don't have to worry about necessarily early exercise or assignment. But for those of you, if you're looking for like this just open-ended, absolute monstrosity of the ability to make money, look no further than a risk twist spread. Now, for those of you, if you've tuned in for quite some time here at TheoTrade, we've got classes, and the classes, okay, are on this RTS spread. Okay, we also had a class in the previous trade was called the VIX Volatility Spread, known as a VVS. Okay, but there's also a class on the risk twist spread. Class is listed under the Big Short, and this is a class I feel really, really strongly about because you can use this risk twist as a hedge to your portfolio. Now, I'm going all the way out to the November time frame, and as I said, I don't want to risk a lot of capital up front. Like I don't really want to get all that cute here. Listen, I just want to put on a powerhouse strategy, okay, that can profit if the market volatility really picks up. And that's what this risk twist spread is designed to do. So in this case, I'm selling one of the 280s, buying three of the 270s, okay, and effectively selling one of the 268s. And the reason I use this particular ratio is it helps offset the skew. Now, before I go into the analytics of this, and as I do drop over to the analytics of this trade, it's incredibly important to recognize you need the criteria in this strategy to effectively trade this strategy. That means you need to know how to open this trade, how to close this trade, to not hold this trade anywhere near expiration. But this is what the risk graph kind of amounts to. And again, this is what we call day stepping. This is looking at how the trade would mature through time. So when I said I'm really looking for this kind of just powerhouse strategy, you recognize here's where the market currently is. If we tank and volatility goes up, okay, you can see the profit really take off to the upside. But here's the one aspect that this risk graph is not taking into account. All right, if the market's going to tank, where is volatility of the marketplace likely to go? And the answer is up. So just here, simulate, just bump volatility up by 10 full points, okay, in this particular expiration, and you can see, wow, it really takes off to the upside almost immediately, right? These are two strategies. Again, for those of you, you're a member of TheoTrade, you've gone through a couple of classes and you're really interested in this. Hey, fantastic. Go look, okay, for that risk twist course. For those of you, if you like the VIX course, it's the VIX, all right, vol spread course. So either one of those courses, it'll walk you through how to not only construct a trade, but how to take it off in the heat of battle. You got to realize, like a risk twist spread, right? This is the 20-pound sledgehammer of risk management tools, okay? But it's also, hey, you might just want to take that huge shot to the downside in the marketplace. And that risk twist gives you the open-ended nature. Markets crash, 6-7% in a matter of a day or a couple of weeks or even a few months. The risk twist can explode. One last thing on this particular front. This is one contract of a risk twist in the spiders. One contract. right? Think of the marketplace and the capacity for this marketplace, for example, just to sell off on a percentage basis. Let's just take the market down by about 8%. With an 8% decline in the marketplace, okay, this one contract is making north, all right, of $1,000. Lot to think about in tonight's video, but one aspect I really like, hey, volatility is dead. Long live volatility. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.